Hey, this is Bert Salazar, and I am the host to the Bert Salazar Retirement Show, which is the only retirement show on Facebook Live. We're trying to connect to Facebook Live, and the same thing is happening. And this has happened it happened last week and the week before that, so we were not able to connect, but that's okay because I'm recording the show. And then I'll go ahead and upload it to Facebook Live so you can all enjoy it. So once again, Bert Salazar, and I'm going to be discussing today, as I do every single week, issues that are very critical for all of us and for all of you when it comes to retirement and retirement distribution planning and tax planning and inflation and, all the different areas of finances that are so critical for each and every one of us as we start to consider retirement at some point in time in the future. In addition to that, I do a weekly podcast. I know that some of you follow me on my podcast channel, and feel free to do so, because the more people that follow me on our podcast, the better off we can communicate to the online community and so forth. Yesterday, I did my 109th episode on my podcast channel. So I do one of those every week. So we've been doing this now, for almost over 2 years now. So I'm excited about that, and I'm very proud of that. And we have a pretty good online community following us. And the title for the podcast yesterday was, "Is your retirement plan on Defcon 1 status?" Is your retirement plan on Defcon 1 status? And for those of you that have heard what Defcon is in the past, but may not know exactly how the Defcon system works throughout the United States and throughout the world with all of our allies, the Defcon system has 5 stages. It goes from Defcon 5 all the way to Defcon 1. Defcon 5 is that part of our system where everything seems to be normal. I mean, we're ready for anything. We're ready for war, but we're not committed to war. In other words, all the systems are on the go. Everything is ready. No one has been mobilized throughout the world, not even our allies from a war perspective. But as you start to come down the Defcon system, you go to Defcon 4, 3, 2, and 1. The big difference between Defcon 5 and Defcon 1 is that Defcon 1, we are ready to go to nuclear war. We have everything is mobilized, all the systems, all the international and American warships that we have throughout the world are on a ready standby. And the President of the United States pretty much has that finger on that trigger. So that's Defcon 1 is not a place where neither one of us and none of us would ever want to find ourselves in. Just to give you a little bit of feedback, and why do I talk about Defcon 1 when we're talking about retirement and retirement distribution planning, the lowest number that we have ever accomplished as far as the Defcon system has been Defcon 2. And for those of you that may not know this, we were actually at Defcon 2 during the Kennedy administration back in the 60s, and it was during the Cuban Missile Crisis in 1962. We were actually very close to going nuclear against Russia, and Russia going nuclear against us. Now, why do I correlate the Defcon system to your retirement plan and to the retirement plan of the vast majority of Americans and many of the clients that I deal with when they first come to see me for the first time? And the reason for that is the following. And a question that you need to be asking yourself is your current retirement plan a Defcon 1 or Defcon 5? If it is a Defcon 5, for the most part, everything should be fine. In other words, you have been able to save fairly amounts of money in your retirement, regardless of what retirement account you have been able to put together. Perhaps you own a business and the business is doing fairly well. You're just looking for ways to now exit out of that business, either on a full-time basis or exit out on a part-time basis. So you may be working 2 to 3 days a week. Your assets are doing well from a retirement standpoint. you have sufficient assets to hopefully maintain you in line so you don't run out of money before you run out of life. Some of the assets and some of the income and the cash flow and those paychecks that you're going to be generating in retirement are guaranteed. So that's a win-win. And you have done a fairly decent job in protecting yourself, protecting your family, and even protecting your business from the risk of the fatal four. And the fatal four are the four major things that are bound to happen to any of us at any point in time in the future. The risk of dying too soon. So if you are at Defcon 5, that means you've done a really good job in preparing for your premature death, meaning you have enough insurance in place to make certain that if you don't wake up tomorrow morning, because no one ever dies at the right time, that your family is not going to suffer financially. If you happen to be married, you want to make certain that there are sufficient assets to mitigate, your surviving spouse's ability to maintain his or her standard of living, for the rest of his or her life. So those are things that you have probably done a good job on. Perhaps you also wanted to set up some kind of a legacy plan. So you wanted to set some life insurance in place, perhaps even inside a trust, in which your children and your grandchildren would benefit from it. And then you can set up different clauses inside of those trusts in order to make certain that you can govern from the grave when it comes to the business distribution of those assets. The other risk that you have probably done a fairly good job on is the risk of living too long. So therefore, if you have sufficient assets and some of those assets are guaranteed, and you were able to provide for the survivor and for your own personal demise at some point in time in the future, then you've done okay. So the probability that you're going to run out of money before you run out of life has already been taken care of through the different planning approaches that you have taken along those lines. The third risk is one that is very critical. But if you're at DEFCON 5, at least you've done something about it, which is the risk of living with a disability. See, the longer you live in retirement, so the risk of living too long and the risk of living with a disability actually kind of go hand in hand. Because the longer you live in retirement, the higher the susceptibility that you're going to have to find yourself in a long-term care situation. If you're a husband and wife in the US, and both of you are 65 years of age today, there's a 70% probability that one of you is going to have a need for long-term care at some point in time in the future. And if you live long enough, then both of you are going to have a need for long-term care. And the cost of long-term care is actually increasing at 3 times the cost of inflation. Yeah, you heard me right. 3 times the cost of inflation. So if you're at DEFCON 5 from a retirement standpoint, that means that you've done some planning to make certain that you can protect yourself and your family from the added expenses associated with the risk of living with a disability. That could be Alzheimer's. It could be a stroke. It could be Parkinson's. It could be some kind of dementia. So anything that can prevent you from living your life and being able to be healthy in life is something that you got to pay attention to. But if you're a DEFCON 5, you're probably done okay. And then the last of the fatal 4 has nothing to do with dying too soon, living too long, or living with a disability, but it has all to do with living with eroding factors. And eroding factors is anything that can erode and diminish the value of your money in retirement. So taxes, inflation, stock market volatility, interest rate volatility, propensity to consume. Are you a spender or are you a saver? Lawsuits, financial fees, all of those things are going to provide an eroding factor that, unless you do a good job in minimizing their liability, can create havoc not only for you and your family, but for your business from a retirement perspective. So being at Defcon 5 means that you've done a lot of good things. And I would applaud you for that if you happen to be one of those. On the other hand, there's always something that you can do to improve that position. But if you came to see me, and after I did my complete audit, I found you to be a Defcon 5, I would be applauding you because you've done a fairly decent job from a retirement standpoint. Now, on the other hand, if you happen to be a Defcon 1, not only does it mean that nuclear war is almost imminent, but it also means that the probabilities that you're going to fail financially in retirement is going to be almost 100%. Why? Because you haven't done any of the things that I have just talked about. You probably haven't saved enough money in your retirement plans. More than likely, all of your retirement plans are probably in accounts that will be forever taxed as opposed to never taxed. The income that you're going to be generating out of these accounts may not be enough, or is probably not enough to maintain your standard of living. They might be able to cover some of your fixed expenses, but they're not going to be able to cover your variable expenses, which are so critical in retirement, because life happens and things change. In addition to that, the standard of living that you want to maintain is not even close to the income and the paychecks that your current retirement assets are either generating for you or will generate for you in the near future. So thereby, there's going to be a major gap. You probably have a major gap based on what you want versus what you need and what you can actually accomplish. You're more than likely have not done anything regarding the fatal four. If you don't wake up tomorrow morning, your family is going to be totally disinherited. You're going to pretty much create havoc for all of them because of the fact that you're no longer here and there's not enough assets to go around, and your surviving spouse may have no choice but to become a Walmart greeter at some point in time in either his life or her life. And if you've been married for as long as I have, at least 30 years, then is that really something that you would want to happen to someone that you've been with for so long? Chances are you haven't done anything about the risk of living too long, because there's almost a 100% probability that if you are at Defcon 1 of retirement, you are going to run out of money way before you run out of life. And if living long could be a bad thing, living long and having no money whatsoever would even be worse. And then obviously you haven't done anything to protect yourself and your family from the eroding factors of life. If taxes were to go up, and which they will be, it's going to decimate your retirement assets, because everything that you have has been in portfolios that are going to be forever taxed. And I'll talk a little bit about that in the next few minutes. If a stock market volatility takes place, as it has in the in the past and has happened in the last few months as well, then chances are you're going to lose a lot of money. And by losing a lot of money, you're also going to lose a lot of the income that you would be able to generate out of those assets. Obviously, interest rate volatility is going to happen. Inflation is going to happen. Remember, inflation is not tax deductible. So unless your assets are earning enough interest to offset not only the inflation rate in the United States at the point in time that you retire, but most important, the tax rate that you may find yourself in because of the fact that inflation is not tax deductible, then chances are you're going to have to dip more and more and take more and more money out of your assets in order to offset those inflationary forces. And therefore, you're going to run out of money before you run out of life, anywhere between 5 to 8 years sooner than expected. And what do you do then? The other thing that is very critical in your eroding factors is going to be all of the financial fees and all of the stuff that you pay. And lawsuits. You know, I have a client of mine that about a year ago ran a red light. It was his fault. And he hit someone, and that person was hurt fairly badly, pretty badly. The person is okay now, but is on a partial disability. And my client has been dealing with lawsuits now for the past couple of years. How long is that going to go on? I have no idea, but he's already paid, told me maybe 3-4 months ago, had already paid like $80,000 in legal fees. And all of those monies have to come from somewhere. So what can you do in order to move from a Defcon 1 status on your retirement accounts to a Defcon 5? Now, depending on the time that you have available before you retire, you may not be able to go from Defcon 1 to Defcon 5. But what if you can get from Defcon 1 to either 2, 3, or 4? You may not be where you want to be, but you're going to be a lot closer than if you stay in the status quo that you have today. The challenge that I have with many clients and with many of my online community is that you follow the definition of insanity, which is doing the same things over and over again and expecting a different result. And those things are not going to happen. So unless you take a proactive approach, unless you audit your accounts, unless you understand, you know, where you're at today. And by the way, many of you are so fearful of knowing where you're at financially today, then you rather not know. And that's a mistake. By the way, I have a number of clients that don't like to go to the doctor because they don't want to have their annual checkups in case there's something wrong with them. Well, you know, does that really make any sense whatsoever? Wouldn't you rather know now if there's something wrong with you, either medically or financially, so at least you can have time on your side to kind of fix it if you could? You know, that would be a win-win. The other things that I find many a times is that, you know, all the clients that come to see me, all of their retirement assets, except for a few that have done a decent job that may be a Defcon 5, all of their retirement assets are either in the taxable bucket or the tax deferred bucket. Now, the taxable bucket is your traditional bucket where the money that you put in, you pay taxes, the money grows every year, you'll get a 1099 on the growth from the financial institution that is managing your assets. And then when you sell the assets, like in a traditional mutual fund, then you'll have to pay either ordinary income taxes or capital gains taxes on the distribution. So, you know, from a taxable standpoint, the taxable bucket is not a very good bucket to own. But I do recommend that all my clients have money in the taxable bucket, because a taxable bucket does something that is very important. It provides you with liquidity. It provides you with flexibility. It provides you with an opportunity hedging account. So I have clients of mine that say to me, you know, Bert, I know that you're always saying that I should have between 3 and 6 months of fixed and variable expenses, depending on the type of business and the type of work that they do in the years that they have been doing the same thing, in order to avoid any potential losses in business and so forth, like what we just went through or are going through right now with this pandemic that we're all dealing with, where many of us were not expecting to lose our jobs. And we have, 33 million Americans that are no longer employed, filing for unemployment. Now, your financial life has probably changed totally compared to where you were at just a couple of months ago or 3 months ago in January of 2020. So you always need to have an emergency fund. Now, sometimes you may want to buffer it up and have a little bit more, because you may be thinking about, you know, picking up a piece of property that you want to buy, or you're going to make some kind of an investment that may be suitable for you and your family. So it's okay. I'm okay with that. The second IRS bucket that you got to pay attention to is the tax deferred bucket. Now, most of you, I would argue, already do that. And you do that in your 401ks and your IRAs your 403Bs, your TSBs, your drop if you happen to be a public employee. But all of you are doing that because the money that you put in, the money goes in on a pre-tax basis. The money grows tax deferred, and then when you pull it out, you got to pay taxes on the whole thing. The challenge is that if you look at the national debt today, is almost at $24.5 trillion. The unfunded liabilities for Social Security, Medicare, Medicaid, and Medicare Part D are $144 trillion and counting. And also the national deficit is almost at $2.5 trillion, meaning that we're spending $2.5 trillion more on an annual basis than the amount of revenues that we're bringing in. So therefore, taxes are going to have to double in the future. And when they do, guess what's going to happen to your retirement accounts if you have them in that tax deferred bucket? Your net is going to be less. You're going to have to live with a lot less than you're living today because of that fact. So you are not protected. And then for most of you, then obviously the tax-free bucket is the most important bucket to have. But the vast majority of Americans have very little money in that tax-free bucket. And the tax-free bucket is comprised of your Roth 401ks, your Roth IRAs, your 7702 plans, which are cash value life insurance plans, and then last but not least, your municipal bonds. Now, of all the four, only Roth IRAs, Roth 401ks, and 7702 plans are totally exempt from the IRS code. The reason why municipal bonds are not is that although you do receive the income from municipal bonds, federal income tax-free, if you own a bond fund and then you sell it at a gain, then you may have to pay either ordinary or short-term capital gains taxes on that gain or long-term capital gains. On top of that, any distribution that you take out of a municipal bond fund or a municipal bond, although it comes in federal income tax-free, it gets added on to the provisional income calculation, which is something that I do every year for each and every one of my clients, in order to determine what percentage of your Social Security benefits will be taxed in retirement. Is Social Security for you going to be taxed at 0%, 50%, or 85%? If you're a Defcon 1, it's probably going to be at 85%. If you're a Defcon 5, it will probably be at 0. And then obviously anywhere in between, you may be at 50%. So understanding how those IRS tax buckets work, it's going to be incredibly important for you in retirement. You also need to consider that the more reportable income that you have out of your taxable bucket and your tax deferred bucket, the higher the propensity for your Medicare premiums to also go up in retirement. So now you may find yourself in a situation where even if taxes were not to go up in the future, a lot of the deductions that you were taking while you were employed are already gone. So even if that's the case, all of a sudden your taxes may go up because of the lack of deductions, exemptions, and credits when you file your tax returns every single year. So these are things that I talk about in many of my videos that I do, and I do about 3 videos a week for each and every one of you, in which I'm bringing information and education to all of you. I do a weekly podcast. I do webinars every other week. So I'm always bringing knowledge to my online community, because even if you don't want to use my services, I want to make certain that I can help you, because at some point in time, you may tell someone else, you know what, I haven't done any business with Bert Salazar, but he's very knowledgeable. He's always bringing good, sound information. You may want to listen to some of the things that he's doing and what he's talking about. So at the end of the day, it's a win-win for everyone. So one of the reasons why I decided to do this Facebook Live every single week, and I do it on a Wednesday, except that yesterday I couldn't get into the system the same as today, so I'm doing it today. But one of the reasons why I do this is I want to bring value. And also, I was talking to a very good client of mine a few years ago. And he said, Bert, I know that you do a lot of stuff out there in the marketplace and you're always communicating and bringing value and doing videos and educating and so forth. What percentage of the people that you educate will actually reach out to you? And I said, well, very little, anywhere between 2 and 5%. And he says, well, you mean that 95% to 97% of the people that listen to you are not going to do anything about it? Doesn't that bother you? And I say, not at all. It doesn't bother me at all, because the motto for my firm is in changing the financial world one client at a time. And I look at my clients and I look at people, I divide people into 3 different types. Those that make things happen, those that watch things happen, and then those that just wonder what happened. So the vast majority of Americans and the many of you that watch my videos on an ongoing basis, you follow the definition of insanity. You gather information, then you don't do anything about it. I don't need to deal with any of those that, you can lead a horse to water, but you can't make him drink it. I just want to concentrate on the ones that value my opinion, value the information that I bring forth, and then reach out because they need my help in some way, shape, or form, either from an accounting, tax planning, retirement distributions, or even estate planning perspective. So, I thought it would be important. Every week I'm going to be bringing you different things, because at the end of the day, my goal is to, kind of help you change the way that you see things. Because when you start to change the way that you see things, the things that you see actually change. So if you're interested in reaching out, you can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And I'll be more than happy to schedule a 20-minute or a 40-minute conference call or video conference call with you in order to kind of discuss anything that may be keeping you awake at night from a financial standpoint. So until then, and until next week, please take care of yourselves. Keep that social distancing as much as you possibly can. And I'll talk to you soon. Take care and have a great day.